This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode number 23 was recorded on July 1st, 2019. I'm Eric Townsend. All-star Jeff Snider is back with us today, and Jeff prepared another of his famous chart decks. You're definitely going to want to download the chart deck. You'll find the download link on our homepage at macrovoices.com next to Jeff's picture. Jeff, if there's one thing that I've learned about you over the years, it's that I can always count on you to have a different and oftentimes more complete perspective on why certain things are happening in the marketplace. Everybody's talking about rate cuts. Kind of feels to me like a rate cut is coming, but I've heard so many different perspectives on why I'm not sure what to believe. Do you think a rate cut is coming? And if so, what's your perspective on what's really driving it?
Yeah, Eric, I think, let's start back at the beginning, and we'll use the bond curves as to sort of a way to frame all of this discussion, particularly about monetary policy and rate cuts and what they're supposed to mean or why they're actually happening. The bond market has go back to 2016 and throughout 2017. The flattening yield curve always said all along, even though everybody had predicted that the economy was going to take off, we would have this burst of inflation, wage-driven inflation, all that stuff. The bond market, by the curve flattening out during that time, said that there was a big chance that something was going to happen before the inflationary recovery took hold, and that eventually what that would mean was that a negative thing happened, negative liquidity pressures, that eventually the Fed would be forced to go back into rate cuts rather than rate hikes, which was the dominant mainstream paradigm at the time. The bond market kept saying, the curves kept distorting and twisting to the point where it said, okay, we're going to get to a point where we're going to actually have rate cuts. And over the last 6-7 months, going back to November, the yield curve has inverted, which is, again, a signal that, okay, the market's starting to price in those rate cuts, not just that it's a small probability or even, just something to hedge against far off in the future. The distortion in the yield curve, the idea of rate cuts in the front, especially the front end of the curve as it twists and distorts, was how the market was saying, okay, these rate cuts are coming, they're getting closer. We're looking at more of them as we go along further into the future. If we go to slide number 4, we've started to see a bunch of indications that suggest, okay, the market's been saying rate cuts for some time. When are we going to start seeing them? And the idea is, a lot of these market prices are starting to say very soon. You got the Eurodollar futures market, the Eurodollar futures curve, which suggests that probably by the July meeting, which is the end of next month, or excuse me, it's actually July 1st, so the end of this month. And then the day after the last FOMC meeting, a week ago last Thursday, or a week before last Thursday, we had the LIBOR curve flip into inversion. The 1-month rate is now above the 3-month rate. The last time that the LIBOR curve had moved into this kind of an inverted situation was back in August of 2007, just prior to the first rate cuts during that cycle. So the market is saying that, we've been talking about rate cuts, we've been talking about something going wrong in the global dollar market. And what the market is now saying is that there's a very good chance that the rate cuts start at this next FOMC meeting, which is at the end of this month.
Okay, Jeff, so it's pretty clear the market is telling us that a rate cut is probably coming at the next FOMC meeting. But I've heard a lot of different perspective on why. Is this about the U.S.-China trade negotiations? Is this about something else? What's driving this? What's the real macro causal factor here?
And that's what everybody says, right? It's, if there is something going wrong, it has to be trade war stuff. But as we go back to the bond curves, we go back to the various market indications. There's something else going on here. And on slide 5, what I want to do is go through what it was a mainstream explanation and what that introduces as far as what might really be going on here. What is the market really afraid of? Because that's really the question we need to ask. If the market is saying rate cuts, we've got inverted curves, we've got inverted LIBOR, we've got all this other stuff, the market is being hedged against something. So what is that that's driving the market to say Jay Powell and his FOMC is going to start cutting rates? What is the market saying that we're afraid of that pretty soon Federal Reserve officials are going to be afraid of too? Now, if we use federal funds market, the federal funds market, by the way, is pretty much a spare liquidity market. It's not what it used to be. There's not really a lot of people operating in it anymore. But going back a little over a year, in early 2018, the federal funds rate started to rise within the Fed's policy range. And that was kind of a curious thing because, again, the federal funds market itself is a very small, out-of-the-way market. It's nothing like what it used to be. And it caught the attention of a lot of people because this was an abnormal indication. And even caught the attention of the FOMC and Federal Reserve officials such that they felt they needed to explain it. And what they said was, back in December of 2017, we had tax reform passed through Congress. President Trump signed the bill. And what that did, in terms of the overall Fed situation, was that it increased the deficit. Thereby, it meant that the government had to borrow more money. It had to issue the way the federal government usually manages its deficit is that it issues more treasury bills, at least in the short run. And so we had what they called at the time a treasury bill deluge, which meant that the way the system works, primary dealer banks had to buy up a lot of these treasury bills and hold them before they could sell them to the public. And what that was doing, according to this theory, was that it was pressuring these primary dealers because they had to then fund this increased T-bill issuance, which then drove up other money market rates, including the repo rate, LIBOR, and 4-week bill rate. So that was the explanation that was given for why federal funds was rising within the range, was that it was this T-bill deluge related to the rising fiscal deficit. But what you saw over time was that the federal funds rate kept moving higher and higher in the range, such that by the middle of last year, the FOMC had to make a technical adjustment in IOER, and then they had to do it 2 more times along the way. So something was driving federal funds upward. They kept on saying it was this T-bill stuff. It was equivalent money market rates to repo rate, LIBOR, and whatnot. But what we've seen over the last couple months, especially the last month since the middle of May, was that the whole story has unwound. Now you see LIBOR rates falling, you see the treasury bill rates falling, and yet effective federal funds continues to be now above IOER. Going back to April 17th, federal funds is above what was supposed to be like a ceiling. So what we're getting at here is, okay, number one, the mainstream story was all wrong, but number two, it's liquidity. That's what we're seeing here. We're seeing the market displaying all the signs of, number one, ineffective liquidity, which is why federal funds is above IOER, and number two, the consequences of ineffective liquidity, which are all falling. Rate cuts being priced out in LIBOR and treasury bills and all of these other markets that say, okay, we have a liquidity event coming. That's why we're going to get to rate cuts. It has nothing to do with trade wars. It is global dollar shortage.
Okay, Jeff, so when you mention dollar liquidity problems, first of all, I assume we're talking about the same issue that has caused you to express the view that the U.S. dollar is likely to appreciate even when it seems like there are other fundamental reasons that it might not. So how do you know that these dollar liquidity issues exist, and what do they mean?
Well, there's any number of ways to see them, and we're talking about in either data or market prices. And market prices in particular are pretty compelling as far as, determining what's actually going on in these shadow places, as you and I, Eric, have discussed with the Eurodollar University and a lot of other different settings. One of the ways we can look at them on slide 6, we're talking about interest rate swaps. And I know swap spreads, a lot of people tend to tune them out because they're complex transactions and they mean a lot of different things. But to me, swap spreads are a very important indication of what's going on inside the hidden marketplace of this offshore dollar system. Because an interest rate swap, on both sides of the transaction, we have credit risk and we have funding risk. So the market is looking at the very things that we want to determine what might be going on inside of them. Now, swap spread compares the interest rate swap price to the treasury rate. But number one, a negative swap spread is an indication of imbalance in the marketplace. The market is saying, hey, something's really not right here. So whenever you see a swap spread go below zero, and the 30-year spread's been below zero since 2008, and now you have most of the swap curve underneath zero again. So you have the 30-year swap spread negative, you have the 10-year swap spread negative, and now we have the 5-year swap spread negative too. And all it's telling you, if you don't really need to know exactly what's going on, what it's telling you is there is something going on in the marketplace. The marketplace is saying, hey, something isn't right here. And because of the way the interest rate swaps work and what the market that it's tied to, it's another indication that there are funding problems, there's liquidity problems in the market that the market itself is perceiving, and that the bond curves tell us that that's going to manifest into rate cuts.
Jeff, on slide 7, it looks like we're looking at essentially the same chart, but this time we're also laying in the foreign repo pool. Now, what exactly is foreign repo pool, and why is that relevant to swap spreads?
Well, the foreign repo pool is a reverse repo program that the Federal Reserve has provided for foreign governments and foreign central banks for a very, very, very long time. You think about the way the world actually works, the way global trade happens. Where does, say, the SWIFT system connect up to the Fedwire system? Where does the foreign dollar market actually transit and connect into the domestic dollar market? And it does that in New York. And what happens is foreign central banks and foreign governments, they hold and create a dollar buffer for this payment system because you have to have dollars available to undertake global trade. And so what the Federal Reserve does at its New York branch is it provides an investment opportunity for governments who are parking spare dollars in this particular account so that they have a dollar buffer for all their global trade terms. And that's what the reverse repo or the foreign repo pool is. It's essentially these governments and central banks holding a dollar buffer. And what we find out is that if we match swap spreads, for example, against the foreign repo pool, what you end up seeing, if you go to slide 8, is that there are periods when foreign governments really build up their dollar buffer, and it just so happens to coincide with these same periods when we see swap spreads compress. So what we're seeing here is confirmation of what we think is going on in the marketplace. The marketplace swap spreads are telling us that the market is perceiving a liquidity problem, a global dollar problem. And oh, by the way, it must be that the foreign governments who have a very fundamental reason for holding a dollar buffer, they see the same thing. So they tend to build up their dollar buffer at the same periods where the swap spreads are telling us the market is saying we have a liquidity or dollar shortage problem. And so what we're looking at here, again, going back to our original discussion, why might there be rate cuts coming? And the market is saying, foreign governments are saying, because they're building up their dollar buffers at the Federal Reserve Bank of New York, what we're seeing here is a liquidity problem, global dollar shortage materializing in all sorts of different ways.
Jeff, as we move on to slide 9, the final slide, I'd just like you to clarify one thing, because when I think about the way the Fed seems to react to markets, usually they talk rate cuts when they're trying to rescue the stock market. You know, the stock market's getting down to that critical level where everybody's afraid if it goes any lower, boy, it could really crash from there. Jeff, on Monday this week, we had gap up all-time record highs on the stock market, yet we're still talking about rate cuts. So obviously it's not low stock market that's spooking them. What is it that's spooking them, or do they even know what's spooking them?
Yeah, Eric, I don't think they know what's spoken, but they can see that something isn't right here. I mean, the Federal Reserve is supposed to do one thing, which is federal funds. They're supposed to be able to control the federal funds rate. And you have to ask yourself, if they're having so much trouble with just the federal funds rate, you have to do 3 technical adjustments to IOER, and still it's not working out the way they would hoped it had. You have to ask yourself as a central banker, what are we doing wrong here? What might actually be going on here? And I don't think it's the stock market necessarily that's got their attention right now. I think it did in December, November and December when the stock market dropped, that got their attention at first to tell them that, hey, there's something really not right here. And so I think what's going on here is the rest of the bond market, which I include things like Eurodollar futures and what we talked about before with swap spreads, interest rate swaps, the market is saying, hey, something isn't right here. It's hedging against severe liquidity risk, an actual liquidity condition that probably is far less than ideal. And oh, by the way, that's actually breaking up federal funds, which is this far away pocket change spare liquidity market. And so the message is getting back to the FOMC that, hey, there's something going on out here. And what the market is saying is that very shortly, in the short run, whatever's going on in the global dollar markets, this global dollar shortage that's building up, it's going to become such such a problem that even central bankers who may not have any idea why they're going to cut rates, they're going to start cutting rates because they're going to start being afraid of the consequences of not trying to solve this problem, even if they don't know exactly what it is.
Jeff, thanks so much for another fantastic interview. We look forward to getting another update in a couple of weeks. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.